Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have with me Elliot Turner and Phil Ordway. As always, we have a great discussion ahead. Elliot, I'll go to you first. What do you have for us this week?
All right, great. Thanks, John. Hello, everyone. This week, I wanted to talk about it. At the very end of last week, I mentioned this paper, Myopic Loss Aversion and the Equity Risk Premium by Shlomo Benartzi and Richard Thaler. And I think it's a really interesting paper, and it's something that's pretty important to think about. And I wanted to tie it to something that I've been thinking a lot about lately, which is the lumpiness of returns in equity markets. So myopic loss aversion is this general idea that the more people look at the prices of the stocks in their portfolio, the worse they do, and therefore the equity risk premium exists because people react to price. And I guess the beginning question is like, so why is there an equity risk premium? In theory, if something always does more, that should be arbitraged away. And it's like the volatility of prices is the general explanation, and how humans grapple with them and handle them. But so one of the other things that I've thought about a lot from my beginning in involvement with the stock market is that, when you look at a lot of the great companies over time, if you look at the market over time, returns tend to be quite lumpy. If you look on a day-to-day basis, even in volatile times, things might look like they move a lot, but when you zoom out, the picture gets quite different. So to put this in another way, from the beginning of 2018 to the middle of 2020, which is basically 2.5 years, the S&P actually went nowhere, though it went a lot of where, right? At one point, it was up like 15% from where it was at the beginning of 2018. And at another point, it was down like 20 some odd percent from where it was at the beginning of 2018. And, in the day-to-day, in the minutia of it all, that really feels like a whole lot. But it's really not in the grand scheme of things. It only took until kind of, the middle of 2020 when we started pulling away from where we were at the peak of 2018. You look at a lot of great growth companies, they spend many years. Look at someone like Microsoft. A lot of people like slinging a lot of blame on Ballmer. And for what it's worth, some of that's probably pretty justified. But if you just take a step back and think about where valuations were exiting the dot-com bubble and what Microsoft had to deliver on to justify some of those lofty expectations, I mean, you got to work your way into that valuation before you can start achieving something more. And that's one of the reasons why returns tend to be, what I'd call pretty lumpy. And that's one of our challenges as investors. Like, how do we both invest on a long time horizon and sit through stocks where at some points they'll be overvalued, at some points they'll be undervalued. Most of the time they'll look like they're doing something on a day-to-day basis, but not really go anywhere in a given time. Technical analysts talk about things like a stock will break out and backtest a level, but when you really, kind of cut through the jargon, to me, what that means is, it goes up, it goes down, it's in the same place, and it takes a while to go somewhere. Another framework I think about it from is, and I think getting older, it's been a little easier to zoom out on things. But, when you're call it a 25-year-old, 1 year is about, what would you call it? It's something like 4% of your whole life. But when you're 50 years old, it's half that impact. And so when you think about a year, when you think about how you get older, time seems to be going faster. It literally is, insofar as it's relative to how old you are as a human being, right? To how long you've been around as a person. So, as you get older, it feels a little easier to kind of let time march on and do its thing. And I think that's one of the benefits that, I think one of the Michael Mobson success equation chapters focused on at what age people achieve their highest skill level in certain domains and their highest performance levels. And I do think there's something to be said about how, in your maybe I think in investing, it was something like the mid 40s was the wheelhouse zone. I should have looked that up beforehand, the exact age, but it was something like the mid 40s was where you achieve your highest level of performance output. And I think there's something to be said about the fact that you reached a certain level where you could zoom out. Like when I was younger, I really wanted, I'd buy something and be like, God, why isn't it working now? What's the problem? And I've come to take joy in some of these experiences that could be a little more tenuous from time to time, that could be choppy, that feel like they're frustrating and where your tires are spinning. I'll give you a specific example. Something like Twitter is a company that I've now been involved with for 5 years, almost 5 years. It's more like 4.5. And it's like felt along the way quite frustrating at times. It's been phenomenal. Early on, it looked phenomenal. In the March of last year, it was still ahead of the S&P for me in terms of my performance, but the Sharp was way lower than the S&P. And now suddenly you have this instantaneous feeling of success in it, though it's taken a really long time to get there. But effectively, when you think about it, I've been involved with this thing for 4.5 years. The return is quite good. I've had opportunities to add to it, but almost all the return has happened within the course of a year. I don't necessarily have a specific point, except for the general sense that the market itself, moves around a lot. A lot of these moves are designed to influence how you think, how you act, how you behave. And by design, I mean in kind of the metaphysical sense. And, it's our job to kind of cut through the noise of this all, to focus on just the business itself. When I think about the beauty of the VC business, and I mean business, not investing in VC, I think it's kind of nice to just have to go from one round to the next and not see the noise along the way. But there's a beauty in doing business with Mr. Market as we get to, because you have opportunities to kind of feed into it. You get certain situations and setups that you can't get in VC. I'm curious what you guys think about the market, the lumpiness of returns, how you handle that, what you do to look past that. One of the things I've tried to train myself is to look at the portfolio a lot less, though being aware generally of if something's happening with some position, like why and what's driving it. Though I do think a lot of the industry spends a little too much time seeing a big move and then kind of backfilling mentally exactly why that happened, instead of saying, I just don't know. Maybe there was one big buyer today. So curious on your guys' thoughts. And, it's very much tied to the behavioral side of investing.
Yeah, it sure is. I mean, I think the thing that jumps out to me is kind of what you said right there at the end, which is, how do you handle this on a day-to-day basis? Because everybody's subject to it. So, no matter where you fell over the last 12 or 13 months, there aren't very many people right now sitting around thinking like, wow, I almost exactly matched the market. Or I had a very vanilla, uneventful return. I just kind of stuck to my knitting and was able to grind out some good returns. There's a lot of people that put up gaudy numbers and killed it. And there's a lot of people that have struggled. And on both sides of that coin, you're prone to making a lot of mistakes, right? Because the people that have killed it are prone to being super myopic about thinking what's just happened is going to continue and that what just worked is going to continue to work. And there are people on the other side that said, wow, I missed out on all this fun. I should throw some Hail Marys or do whatever to try to catch up and join the party. And I've got a lot of lost ground to make up and that sort of thing. So it's a huge problem. It's a huge risk. I'm certainly not immune to it. I think what you said, Elliot, is important for me anyway, which is that, I spend a good part of my day actively trying to avoid market noise. So every morning, first thing, I'm broadly aware of what's happening, what futures are doing, what's happened in the world overnight, what's in the news, that sort of thing. And that's a, 30 to 60 minute kind of exercise for me. I read maybe a little more. I generally read several newspapers, a lot of blogs, check Twitter, have a scan around the markets and see what's going on. 98% of time, that ends right there. And I go back to whatever it is that I'm trying to actually work on and get done. And I will do my best not to pay any attention to what's going on a tick by tick, hour by hour kind of basis. So obviously, if I'm trying to actively buy or sell something, that would be different. But there are weeks and multi-month stretches where I don't actively make any changes whatsoever in the portfolio or in any investments that I hold. So I think that helps, right? I mean, I know a lot of people last year that only stayed sane because they adopted that strategy, right? It was like, all right, I'm going to do all of my thinking and research really early in the morning or in the afternoon and evening, and during the day I'm going for a walk. I'm going to do something else because I can't sit here and watch the market bounce around. I'll lose my mind. And look, I think there are some people that are kind of pre-programmed to behave differently, and they can sit there and stare at a screen and react minute by minute to it. But I think those people are all very much a securities first kind of investor, which gets back to I should probably just rename everything that, because it's like if you're a securities first investor, everything I just said really doesn't apply. But if you're an investor who's looking at the business in any way, shape, or form, and particularly looking at the business first to inform your opinion of what the securities may be worth, this is pretty valuable. But beyond that, I mean, Elliot, I think everything you brought up, it encapsulates so much. All the behavioral factors that you should care about tie into this, and it actually is part of what I'm going to talk about in a little bit. So it's such a broad subject. I wish I had a more succinct way to sum it up. What about you, John?
Yeah, I mean, it's been a huge issue for me, and probably the thing that's held me back the most on my own investing journey has been exactly this. Whenever I look at my portfolio frequently, I tend to do much worse because there's more turnover. I don't want to see a down day just instinctively, So I've been guilty of seeing one of my holdings, which I think is a core holding and a company I'm going to hold forever, have like a up 15 or 20% day on no news, and I sell it, or I sell part of it, just because I feel like, well, it's probably going to drop 5% tomorrow, and I don't want to see that red. And then, there have been cases where that leg up just continued, and I saw myself get out of a position that I thought I'd hold for years, where I was so sure of the thesis. And then what do? When you sell on that up 15 to 20% on no news, and then it goes up another 10% on no news the next day, what then? And then I don't get back into it, and that has cost me a lot. So what I've really learned is that the less I look at the portfolio, the more I have a hobby or a day job that's not related to investing, the better I do, because I just don't have that temptation to try to kind of trade around core positions. So this has just been huge, and I'm still learning this, but I feel like I'm much closer to getting this right now than I ever was in the past. Little things like I have a few accounts with Interactive Brokers, and for one account I'm using the Interactive Brokers app on my mobile phone, and that's like the play account that I basically just use as a like someone might use a gaming app, and I have very little in there. And then the real accounts I don't actually look at. There's no app. They're kind of hidden in the background, and I try not to access them for a long time. And boy, do they perform better. So I feel like really structuring and managing your environment to not look at your portfolio very frequently is kind of like, if you want to eat healthy, don't keep unhealthy food in your kitchen, because we all succumb to these human weaknesses. And it's really about managing the environment to the fullest, so that we stay true to our long-term goals.
Yeah, it's really interesting you mentioned that, John, because that's one of the things I was thinking about, was how much harm, in my opinion, we can't I don't know if you're ever going to be able to prove the counterfactual of what would have otherwise happened. But in my opinion, I think the behavioral research is quite clear that the instantaneous, always omnipresent ability to trade everything at all times via the phone in your pocket is going to be a huge net negative across the entire investor world. Because just like you said, I mean, your anecdote about returns being better in your real account versus your, go anywhere interactive brokers play account, however you want to frame it. I think that is consistent with other people. And I think that study at Fidelity that people have always referred to, that the best returns were from people that died and, or forgot they had an account. As far as I know, that's apocryphal. I'm not sure that's ever.
I was thinking of bringing that up, but didn't for that reason. Yeah.
Yeah, I've looked into it. I certainly haven't found any evidence of it. If anybody out there has any sort of ability to verify that, that'd be great, because I've actually looked and couldn't find it. It could well be true, but I think at this point it may be more apocryphal than anything else. But I think the behavioral principles of it very much stand, right? So I think the point remains that, unless you're one of the tiny fraction of people that is running a securities first kind of operation, and you can pay exquisite minute by minute attention and not get sucked into the mistakes that come with that kind of myopia. And there are those people, right? I mean, I'm not disputing that. I just think that most of us aren't among them. And so if you're not among them, you're probably going to be hurt by having constant access to your portfolio, feeling every little up and down, or just, even taking a step back from that. I mean, I can't tell you the number of people I know that are not professional investors, or maybe they're kind of involved in finance and investing in the markets in a tangential way. And they told me both at the time and later, boy, I opened up my accounts in March of 2020 and that really hurt. And that left them in a bad position, right? They were either emotionally fragile, or they're extra scared, or maybe they became extra greedy, who knows? But I mean, it's such a fraught area. And there's just, there's so many behavioral principles that tie into it that you have to overcome. And like you said, John, I think you have to be aware of these sort of things and really structure the environment around you, or it's gonna end poorly.
I love that name you have, securities first investor, because I think it's both, it's just such a good way to describe it. There are a couple things that there are some things we could learn from securities first investors. One of the things that I was thinking about during the, call it the GameStop saga, is you look at what the hedge funds who were having trouble owned, and you follow some stocks and you see if anything on your watch list is there, and you set some alerts way beneath the price, or even throw out limit orders and see if you get hit. I got a sizable increase in one of my positions because I knew two of the hedge funds that were in trouble had a blowout of this, slightly less liquid mid cap company. And it was fantastic because the stock bounced back pretty quickly. So we could scrape those kinds of things. One of the other things I think about that I hear from a lot of value investors, like people, who get a quick pop, or who, have this inclination to sell something that's up quickly. One of the problems that you run into is the framework and construction of your thesis. So if at conceiving your position, you think you have a 3-to-1 risk reward, thinking 3 to 5 years down the line, you're going to get something like a 2 to 3x multiple of invested capital. And you're willing to hold it down. So if, in the coin flip of worlds, the stock goes down, call it 30% before it goes up, you're willing to hold it down 30%. But if you then sell it when it's up 15% really quickly and then move on to the next thing, you're kind of not realizing and actually ever letting true odds play out, though you are if the coin flip goes wrong first. So you're putting yourself in a position to, it's like, I don't know a name for it. It's like the opposite of loss aversion. You're putting yourself in a position to kind of cap all your upside, but handle and deal with all your pain. And in a Kelly criterion framework, if you were to use that to kind of define whether you do or don't make a wager, do or don't take a position, it could leave you in a pretty sub-optimized, call it betting framework. I hate using the word betting, but I don't know a better word for that, as an investor over time. So that's one of the really hard things when you have like quick successes. And it's also hard to know that, the day you make a choice to invest in something is absolutely a coin toss on what it does next. There's no way around that. Like you basically, if you want to be a long-term investor instead of securities first, you have to understand and you have to accept that you might look wrong before you're ever right. I've said this on the pod probably more than once already, but Roku, I didn't have a single up day and my first couple weeks owning the thing, it was down 30% before I ever had a single up day. Doesn't feel good, but when you look back on it now, it's quite different. But yeah, those are some of the thoughts that kind of come together. I don't know a way totally around it. I loved Guy Spear saying that, he tries to look at his quotes once a week, but I think that's incredibly aspirational for someone like me. But it's something that I think more people should talk about and should think about, because I think the more you talk about it, just like with any problem, like the first step to addressing a problem is to acknowledge it exists as a problem. So the more we think about it as a problem, the more we kind of like, I don't know, you could put some mental, call them roadblocks in your process to give yourself a predisposition toward inaction in contrast to action. And so I've been able to take myself from having been a keyboard monkey at one of those trading desks to making no more than like, a handful of, call it two-way transactions. I have to sell something to buy something because I don't have, inflowing capital. So, but still, I still think of it as 5 decisions a year. But putting roadblocks, setting certain targets, even if they're not like actual targets where when I say 20% turnover, I think one of the things in Idea Week last year that really helped me was I was pressed on the question of, do I really want to set that as an actual target? I'm like, the more I've come to think about it is I don't need it to be an actual target. What I need it to be is like a framework and a signal that, I really should confine myself to only a handful of moves a year. And, that puts less pressure on making decisions and gives less impulse opportunity to act on you.
Yeah, one thing that really helped me with my own struggles in this regard, and I've always kind of considered myself a concentrated investor and kind of prided myself on that, I'm not afraid to concentrate in my best ideas. And then I realized if I have a lot of turnover, because something seems to have worked out quickly, I am actually not concentrating through time. I'm kind of jumping from idea to idea. And inevitably, as you say, Elliot, you kind of end up on your worst ideas, because those are the ones that somehow just don't work out. And you kind of basically sell out of your best ideas too early to then settle with the ones that are not so good. And so just thinking about concentration, not just at a point in time, but through time, has helped me deal with this, because I want to own not so many companies over a good stretch of time, because I feel now that gives me the best chance to actually find the ones that are going to be big winners.
Yeah, that's a good point, John. I actually have an example of where that sort of framework led me astray, because I can be pretty patient and sit tight for years on end, but where I've misdiagnosed the underlying opportunity or misweighed my own opportunity cost, it can ultimately be compounding my own mistake, basically. So when I first launched in 2013, one of the first things I bought was the equity in a company that I had known for several years, and it had been involved in a bankruptcy after the financial crisis. And I had spent literally hundreds and hundreds of hours looking at it. And I just ended up selling it in 2020 because so many things had gone differently than I had planned on. But every step along the way, I thought, okay, well, this has changed, but this has also changed, and I'm going to give it a little more time, and I'm going to give it a little more patience. And thankfully, I didn't really waste any money. I mean, I wasted a lot of opportunity cost, because not only did it originally go straight up, it was kind of like the opposite of Roku, Elliot. It was like it went straight up in the first, 6 months I owned it. It was probably up 75%, and I thought it was still a little bit cheap to what it was going to ultimately be worth. So I didn't sell it. And then it went basically straight back to where it started. And for the next 6 years, it just bounced up and down in a relatively narrow range. And all it resulted in was a huge waste of time. I ended up selling it almost exactly where I bought it. And, obviously I could have done a lot better with that. I hope anybody could over that period of time. So the opportunity cost was material, but even more than that was the return on brain damage. I mean, I think that concept has picked up steam, and it's a very valid one because I spent more time. I mean, at one point I actually spent a good part of my Christmas holiday in 2015 or 2016. I'd have to think about it. Helping to find a new CEO for the company because there were a ragtag group of shareholders that were all involved. The board had kind of abdicated their responsibilities. It was just a total fiasco. I mean, everything about this company sucked. And I never threw in the towel when I should have because I was kind of myopically focused on the wrong things. So, it's taught me a lot of lessons, namely, like you said, John, that if it's not the kind of thing where I really see, that multi-year potential and not just a reversion to what I thought the mean was supposed to be, or not just a thesis that I had previously bet on or previously anchored on that isn't playing out. It's time to just move on.
I really like that return on brain damage concept, or like returns per unit of stress, because it definitely matters. And like bad decisions beget bad decisions, frustrations beget more frustration. It compounds on itself. And so, when you have one thing not going right in your portfolio and it's taking up a lot of time and a lot of mental energy, you're more vulnerable. It's just not good. It's not healthy, and it doesn't help. A mentor has impressed on me, like, do stuff that makes you more narrowly define your universe of investable opportunities. Focus on only companies who fit your definition of, I think there's a degree to which it applies more to my style, but like high quality. Don't settle for companies that don't truly fit the bill. Though, granted, everyone's got their own definition of quality. I've been told by more than a few people that Twitter is not quality, but there's certain qualities about it that I think, sorry, not going to go down the Twitter tangent there. But needless to say, narrow your universe and end up with a field of companies who kind of avoid getting into that brain damage situation. And I also, Phil, your experience brings to mind a quote I heard from Mike Non-Gap this week, which was something to the tune of, if you are an activist and you end up with a board seat, you failed miserably along the way. And it's like, you really want to think about what success looks like when you start a position, when you get into a position, and when you're on your way there. And don't let the stock price determine that along the way, and change your path and change the time frame over which you're measuring success too. That's one thing. Like, on Twitter, I've had a couple people be like, great job on Twitter itself. But as far as I'm concerned, like, I'm not judging for another 3 to 4 years. Let it be determined over time if it truly actually worked. But price itself is just trying to influence you and trying to get in your head, try to get you to be cocky at times when you should be cautious, and try to get you to be scared at times when you should be greedy. And it's exactly the opposite of what you're supposed to be doing. So it's hard. And that's our challenge, right? I think that's the hardest part of the job. You have to be very self-aware too. So I think exercises that promote self-awareness are quite helpful, whether it be meditation or exercise, whatever floats your boat, but something along those lines I think is really helpful. One thing that I've had as a rule of thumb that I think does work as well is, I think it works better in my framework of making a few decisions a year, but the day I make a decision is not the day I act on it. It's the next day that I act on it. Because if I don't wake up thinking that the prior day's like actual decision was right, I still have that out. But if I wake up and I feel inspired and I'm like, yes, let's go, then I think that's a little more right. There's something slightly spiritual about that, but I think there's some truth to, like, sleeping on things really does make you give you a degree of clarity that you otherwise wouldn't have. So I'm trying to think of a couple more of my mental hacks to impose patience. But I think one of them is start very slowly with a company. Don't start with your full-size position. I know some people who say stuff like, if it's not worth so-and-so % position in my book, I'm not going to spend the time on it. But I think there's something to be said about how you feel once you own a stock and you see what does influence price. If you see the markets acting on all the wrong, like fundamental things, like earnings report reactions, where the stock moves, the opposite of what you'd expect. One of my worst mistakes ever was selling NVIDIA too early. And it was like every earnings call, it was like they destroyed their estimates because of server, and still PC was doing well. And every analyst was asking about Tegra this. And most of you who know NVIDIA today probably don't even know what the hell Tegra is, but it's like, every time people are focused on the wrong things, you get interesting signal, and you start knowing about when it'll actually start working for the stock, and you get a better feel. And you could maybe put on that securities first hat at a certain point when you feel that the inflection has actually happened in how the market's perceiving these things. I think there is that sort of room in there. Any little hacks you guys have in that sense?
No, I mean, I would add real quick that, even though I've spoken a lot, maybe too much about business first versus securities first as a framework. I mean, I think the reason I keep harping on it is just because I think it's important, and I think it just creates a lot of mistakes when you don't explicitly acknowledge up front which of the two camps you're trying to live in. But that said, I think there are a lot of things to learn from the other side. So even though I'm explicitly a business first investor and I want to understand the business and try to figure out what the whole business is worth and where it's going, and evaluate the people involved and all that kind of good stuff. I mean, there are lots and lots of elements from the securities first camp that are valuable and worth thinking about. So I'm certainly not looking at technical analysis and charts per se, but I'm more than happy to acknowledge their utility in other landscapes. Or I'm perfectly happy to acknowledge the fact that I would look at things like, short interest, for example. If I'm looking at a company and I find out that a lot of people are short it, I sure as heck want to understand why, right? And chances are most of those shorts are probably doing it on a different basis than I would be, shorting things on a different basis than I would be. But there again, when this is a bit upside down, but when you're short, you almost by definition have to be a kind of 50-50 business first, securities first, because you just can't short a lot of things until something starts to crack, right? So shorting is by definition more tied to the market and a more sweating it out day by day, hour by hour kind of thing. And you have to kind of make your thesis and do your homework and then lie in the weeds until something ruptures and then you pounce, right? So those are all perfectly valid intellectual frameworks. And it's just like anything else. I mean, almost anything that's valuable and true about investing comes with a paradox. And this is one of them.
100%.
I feel like there's so much psychology that goes into this, how you evolve a position over time, that it's just, it really is an art, and it's an art in knowing oneself, because I've been there where, I took too large of a position early on because I was excited and then got really scared when it didn't seem to be working out. And if you kind of don't go so big early on, it gives you a little bit more leeway to stay clear-headed. Somebody I think tweeted something recently that I could really relate to, which was make the position size so that you are indifferent about the stock going up or down in the short term. Like if it goes down, you can add to it. If it starts going up, you don't feel like you have too little. That's kind of interesting. I don't know if that's actually possible, but I feel like it's you can kind of.
You always have too little if it goes up, right?
True. Yeah, but sometimes you really have too little, when it's not really moving the needle. But at other times you can have too much to where if it starts going down, you're just getting worried instead of getting excited that you can actually, increase the position. So yeah, I don't have the answers, but I would like to believe that I'm learning and getting that more right over time.
Yeah, I agree. That's something I've definitely learned the hard way, starting when I had to take responsibility for a portfolio and including every day up into the present, that you have to have a framework in place for the portfolio and what you're willing to do, right? So for me, I'm not going to take a really tiny position, and I'm certainly not going to put some absolutely enormous chunk of my capital. You see people occasionally put 50 or 75% of their capital into one idea. And obviously people love to throw out sound bites about other great investors doing that sort of thing from time to time, and good for them. But I think it's a really tough proposition, especially if you're managing other people's money, to say I'm going to have 50 or 75% of my capital in a single security. I don't care what that security is. But so let's say I'm going to have position sizes between X and Y. And then to your point, John, if you can't become detached and unemotional about what the price of that security is doing, it's a pretty good sign that something's wrong, right? Either that your position sizes are totally out of whack, you don't understand what's actually happening with the investing, you're too emotional from something else. Because again, I mean, it's a paradox, but I want to, if I own something and the price has gone down, I'm going to double and triple down on my efforts to figure out why I might be wrong and what the price signal may be telling me. But if I'm choosing to make that active decision to own it in the first place, there's at least some good chance that the market is just wrong for whatever reason, right? I mean, like Elliot's Roku example, where it went down straight in his face for however many days in a row, and all of a sudden he wakes up and he's 30% underwater on the thing, but nothing had really changed. Nothing about that was necessarily relevant to the future. And so thank goodness he wasn't shaken out of it because he was, uninformed or too emotional or whatever. So if he had run face first into that 30% drawdown and been scared, that would have been a sign that he was either way too big or way unsure of what he was doing. And on the flip side, to your point, every time something goes up, you don't own enough. We've all had that feeling, or all had been yelled at by people on that. I mean, that is true. I mean, look, it's a huge mistake to leave money on the table when you know what you're doing. I mean, Julian Robertson used to always say that was the only thing that he was good at, right? That he wasn't right more than anybody else. He wasn't smarter than anybody else, but he was among the best at really pouncing when he was right and really doubling and tripling down. I mean, sometimes it's really, really hard to buy more of something when the price has gone up, but that's could be the right answer and be the most profitable possible decision you could ever make. And so it's something you have to learn.
Yeah, that's a really good point. And I'm glad you mentioned the Julian Robertson example, because there's also like a Soros had a similar thing. He would know he's right before the market would know he's right. He'd make a lot of bets and he'd have a thesis on a lot of different things at once. But when he was right, he knew it really fast. And I have a mental hack for that too. When I start with a smaller position and it goes up and I want to buy higher, a lot of people anchor to their original price and they're like, oh, I can't pay this price. What I think is what I try to do is, knowing what I know now, what price would I be happy with if I had the chance to buy it again, and buy up to where my average price gets to that point, or up to where a position is kind of, at my ceiling size. But that's a mental hack to be able to buy higher without thinking about the price you're paying right there, but what your total price is on the total position size, where you could live with and be happy with, knowing everything that price is the right one for you. It's not perfect, but I think it's a good, I think I do find mental hacks to be quite helpful in that sense, because so much of this is behavioral and psychological. So that's one that I take. And then, just to bring up, I saw a great tweet from Bill Brewster. I think it was yesterday or the day before. It was my grandma 31x'd her Coke investment. What's the saying? Time in the market is greater than timing the market. So like back to where I started this conversation, most of the time stocks do nothing. There's this general kind of tailwind that stocks have over the very long term. And if you get a good one, that tailwind's going to be even better than the tailwind stocks in aggregate have. But then when you look back, you could probably say even, most of the return happened in a few very, very small number of the days. Like, think maybe like less than 1/10 of the days were actually meaningful to the return, with most of the days canceling out one another. So, that's one of the hard parts of this all. You could be wrong for a long time, and then suddenly, just over the course of a couple of weeks, you end up very right. And I think that's the beauty of this all too.
I just saw it great. I apologize for forgetting where I saw it, but somebody sort of speculated in jest that you could explain all of Renaissance Technologies returns by the fact that instead of like day traders trading furiously all day and closing their book to zero effectively by the end of the day, anyway, backing up a step, the point of this research was that like some enormous percent of the market's total return over the years was actually accrued while the market was closed, right? So market moving news came out at night, early in the morning, over the weekend, whatever. And so you weren't necessarily even given an opportunity to trade on that information. You had to have already owned it going into that, to your point about time in the market rather than timing of the market. And that maybe you could explain Rentech's, amazing returns in its partners fund by just having done the opposite of the day trader's book, which is going levered long the market at close and then undoing that at the open the next morning. Kind of funny.
That was one of the hints in The Man Who Solved Markets, I think is the name of the book, that, the first 45 minutes of the day is the greatest inefficiency too. So, I mean, that's probably onto something. Yeah. Not going to lie.
Yeah, or like post-earnings announcement drift. That's a well-observed phenomenon as well. Well, let's move on to you, Phil, for our second topic, which I know relates to what we've been talking about already.
Yeah, it sure does. Thanks, John. So I thought today I would tackle a project that I've alluded to on here before, which was, a talk that I gave actually at your conference, John, in 2016 or 17. I'd have to go back and check. It seems like a lifetime ago now. But I basically took the famous Charlie Munger speech that he gave in, I think, 1994 for the first time, The Psychology of Human Misjudgment, where he goes through a couple dozen very prevalent, insidious psychological biases and walks through what they mean, what the implications are, and then tries to tack on some vivid examples to drive them home. And so he uses things that he drew from his own experience and from, the news of the past few years and decades at that point. And so my thought in doing this, about 4 or 5 years ago was just that it's, first of all, if anyone hasn't listened to it, and hopefully there's nobody listening to this podcast that's unaware of that, but if there's anybody out there that hasn't listened to it, their podcast talk, it's on YouTube. You can find a transcript. It's in Poor Charlie's Almanac, so it's all over the place. But if there's anybody that's unaware of that talk, they should go and find it immediately, like right now. Stop whatever you're doing. It's one of the most interesting, impactful things I've ever come across. I've probably listened to the audio version literally dozens of times. I've read it at least 5 to 10 times, if not more. It truly encapsulates so much about investing from the behavioral sense. And it's amazing too, because it was actually done before a lot of the foundational work in behavioral psychology or at least before some of it had been published by people like Kahneman and Tversky that, went on to win a Nobel Prize for good reason. So it really was ahead of its time. So my idea was just that this is the greatest thing ever, and it'd be even more useful to the current generation coming up if we could update the ideas in it to, make them more applicable and make them more salient to people living in today's world rather than, thinking about things that happened 30 and 40 years ago. So in the spirit of the investment checklist principles and quotation stuff that we talked about last week, where we put those in the show notes and I shared them on Twitter and hopefully people find something useful out of that. This is even more useful. This has almost no possible caveats or drawbacks. And so I thought I would also use it as a chance to go out to people and ask for their ideas about new examples I can use to rework this. And I don't know when I'll actually get to rewriting and updating the document. I will share the transcript of the document or the manuscript that I prepared from 4 or 5 years ago, and people can read that. And then at some point later this year, I'll go through it and add even more examples, because for better or worse, my goodness, the past few years, just going back through from when I wrote it, have provided a lot of vivid stuff. So to give people a flavor of kind of the concepts and the topics that are in there, if they're not aware, and as I look at them, I mean, again, one of the principles of this is that you get the craziest results. Things like GameStop, when 3 or 4 or 5 of these factors all combine and start pushing in the same direction. So things like commitment and consistency tendency, where you have some sort of held belief or you've made some sort of commitment, and it's just hardwired into the human brain to want to stick with that and not to reverse yourself, not to, admit that you were wrong, not to look foolish. And that is just another way to frame it is inconsistency avoidance, right? Humans have an enormous pain that's caused by feeling inconsistent, that they've somehow been inconsistent. Anchoring, pricing in the market is a huge issue here where, people are often led totally astray by thinking the price was here, now it's higher or lower. All I have to do is just wait and we'll somehow revert to this magic level. And that really has nothing to do with it. I mean, the worst anchoring effect is almost always your previous conclusion, right? If your previous conclusion was, I don't understand this, right? Or I've missed this. It's gone up too much in price. I'm too late to the game, or I've already made a lot of money in this. So what could go wrong, or anything like that? Whatever your previous conclusion was, is probably the most likely source of your next mistake. And so if you're just constantly trying to tear down your previous decisions and your previous conclusions and not anchoring to anything, you're going to be way ahead of the game. Simple psychological denial, where something has just gone wrong. You believed something really traumatic and painful has happened, and you just can't even cope with it. It's just simple human nature. We're all subject to it. Reciprocation tendency, or the Kantian fairness principle, revenge is all tied together. You see that on an almost daily basis now, unfortunately, in all sorts of realms of life. Bias from over-influence by social proof. You could also say social media, even though that didn't really exist when this originally came out. Namely, just the conclusion of others, right? So you see this in all sorts of tribal behaviors, from politics to sports to all sorts of petty social cliques and all that kind of stuff. So you have, and by the way, that's exaggerated and taken to an extreme when it's under conditions of uncertainty or stress. It can really get out of control. And then lastly is deprival superreaction, which is the basic core fundamental principle behind all gambling, right? And this is one of my big problems with something like Robinhood, is that they're very smart about what they've done. I mean, it's the same principle as a slot machine that has you put in a few quarters or a few dollars and it's bar lemon, right? That's not a mistake. They're trying to make you feel like you've just missed, right? If you had just gotten in a little earlier, if you'd stick with it a little longer, you will finally get that big jackpot. And that is an enormously powerful concept that I think people need to really be aware of. So some of the examples, there's some really good ones that are already in there. I mean, one that came up the other day when I was talking to somebody about sports. Elliot, I know you like sports. John, you'll appreciate this too, because I know your son plays soccer, football. There's a guy named Carlos Kaiser. He's a Brazilian player from the 80s and 90s. His birth name was like Carlos Raposo. But back then, it was coming out of the age when Franz Beckenbauer was one of the best players in the world, and he was known as the Kaiser. So this guy, Carlos Raposo, renamed himself and started referring to himself as the great Carlos Kaiser. And he created this whole shtick around himself where, even though he literally never played a minute at any meaningful level of football, he was such an engaging personality. He had the perfect look of a Brazilian superstar from that era, everything from his, physical stature down to his perfectly coiffed mullet. He would befriend these very powerful players and make sure that he took them out. He'd party with them. He'd become friends with their families. He would actually court and sometimes pay off journalists to write favorable things about him in the press. And he perpetuated a scam on the basis of this, whereby he'd never proved even once that he was capable of playing. He'd roll in on a new short-term contract, and within, the first training session, he'd inevitably pull a hamstring or something, and he'd spend the next 6 months on the bench, being the best teammate you could ever imagine, but never putting anything out on the field because he was incapable of it, right? But this fraud went on for 20 years. Where this guy made unbelievable amounts of money. Every big club in Brazil, particularly in Rio, took a chance on him because they'd all buy into this same gambit over time, right? I mean, it's just unbelievable how powerful the psychological principles was. And he said his guiding principle in life was that life is all marketing, right? That's what he would tell himself over and over again. It's just life is marketing. And he got all of these unbelievably successful people that played this game at the highest possible level, and they couldn't see through his BS, and it's just fascinating. So anyway, moving on to more commonplace examples today, more recent examples of today. Obviously, what just happened with GameStop has to be included in the 3.0 version of this talk. Everything. There have been a lot of examples, unfortunately, coming out of the pandemic, coming out of the recent political environment. Wirecard, the massive fraud in Germany, is a good example. Joe Low and the billion-dollar whale scandal in Malaysia is a fascinating example. I mean, Joe Low is basically the Carlos Kaiser of the finance and international development world, right? I mean, it's pretty stunning. The 737 MAX fiasco at Boeing has a lot of echoes to prior situations where just 3 or 4 or 5 psychological factors. I mean, again, my personal opinion, having read it as a non-expert, is that no one ever woke up at Boeing. We talked about this. No one ever woke up at Boeing and said, I'm going to commit some sort of act and cut corners and do things wrong. It was a bunch of psychological mistakes that all compounded on themselves. The same thing I think happened at Valiant and Enron and everywhere else. So anyway, I just thought I'd open it up to where people can submit any sort of example where they read through these psychological principles and say, oh yeah, that's exactly what happened here. And, you name the company or the situation or the example in real life. And when you do that, instead of, becoming prey to it, when you become more aware of that, of those principles and those biases and tendencies, it helps to make you almost more immune to them, right? And the more you study them, the more self-awareness you have. Because I should give the due credit to this. Jason Zweig helped me a good bit with this. He's not only kind of the dean of all investing journalism, he helped Danny Kahneman write Thinking Fast and Slow. I don't think a lot of people know that. He should get more credit for that. And he said, as it pertains to this project, that, having spent however many decades it is now studying the great investors like Buffett and Munger, it's not so much that they have a lot of the advantages that a lot of people often attribute to them, even though they do have those advantages, but maybe their biggest advantage is that they know who they are and they're comfortable with who they are, and they don't stray from their own abilities, they don't stray from their own knowledge, and they're just not, hurting themselves. I mean, again, I've always thought that one of the most important and overlooked lines in the Intelligent Investor, gets so many sound bites and whatever out of that, is that the investor's chief problem or even his own worst enemy is likely to be himself, right? Ben Graham wrote that 7 or 8 decades ago, and it's never been more true than today. And so by studying all of these little bits of psychology that generate human misjudgment, I think you can be less of your own worst enemy going forward. So I'll leave it there. And if you guys have any examples that jump to mind, I'll add them to the list and hopefully include them in a future edition. And then we'll put it out in the show notes and people can chime in there too.
Phil, that was fantastic. So good. So interesting. I had to look up Carlos Kaiser while you were talking just to see that mane of hair.
It's great, right?
The story is fantastic. Oh my God. I mean, 20 years of that. And I was thinking it's nice you tied it back to like Jolo in investing, but like there are at least a handful of those kinds of characters in our industry.
Sure.
And it's definitely a little scary to think about because it's that much easier to pull off in finance and investing than it is in athletics. Where, I mean, especially now, at some point you got to show the goods. One of the ones that I think about, and I don't know how to phrase it, but one that I'd really love to add. I mean, I was thinking about it a lot just the last couple of days, the amount of times I've heard the word super app, and it gets me thinking about the use of the word flywheel in like investor presentations. And I'd call it like these vapid, meaningless words that could be used and interpreted however anyone wants in any different context. Where maybe once they served a purpose and had an actual point, but they just start getting used in such, I don't know, cascading ways where it snowballs into something that just loses any sort of grounding.
It's yoga babble.
What did you call it?
It's yoga babble, right?
Yoga babble, yes.
Yeah. So you're right. Yeah, I actually have a friend who wrote his entire letter about flywheels and how just completely bastardized that whole concept has become.
Right. Like it's a good concept and all, but the way companies use it over and over, it's like, don't even, when I hear it, it's not even like, that's not a flywheel. What are you talking about?
Right.
Yoga Babble. I love it. I love it. That's one I feel like I encounter increasingly often. Definitely going to have to brainstorm on some more of these. Those are fantastic. I love the one on inconsistency. It gets me thinking way back to the 2004 election where John Kerry was accused of being a flip-flopper. Oh my God. Like, it's a great thing to be able to like look at something and be like, I've actually changed my mind on that. I feel like that's something that people should be praised for repeatedly. It's not a bad thing at all. I mean, I'd rather you change your mind than go head first into a terrible idea because you committed to it beforehand.
Isn't it amazing how quickly that can swing back and forth, right? I mean, just a few years later, it was viewed as a cardinal sin if you didn't blow in the wind with whatever was popular. And it's just unbelievable.
Yeah, and I think there's this strain of thinking in tech world that kind of takes the other side of it too far, this like strong ideas, loosely held concept, where you're like so passionately arguing something, and then you're like, actually, nah, I don't think that's the case. There's a good middle ground between the two. I mean, maybe like just take a more nuanced approach to the world and be open-minded. That's good, but it doesn't have to be a strong idea.
Yeah, one of the things that drives me the most nuts on Twitter is the not just yoga babble, but the pseudo psychological babble that comes out a lot of. And again, I'm going to criticize by category and not name names, but it tends to be extra concentrated among very wealthy tech entrepreneurs and venture capitalists. That it does not matter what the subject is; they've got some vapid pronouncement that is just going to solve all the world's problems if you will just let that soak in a little more. And it's so ridiculous and infuriating. And like you said, I don't think it's kind of funny because I feel like on this topic, there's a handful of people, Jason Zweig, and not just the foundational people that have practiced this, but people that have called this stuff out for years and years and years. Like chances are, if we're talking about something, there's a Jason Zweig article or something about it, like the Devil's Financial Dictionary or a Michael Mauboussin paper or whatever. But just today, Jason Zweig put something up that said, what's one term or phrase that a lot of people use where the speaker himself really has no clue what it means, and it was pretty funny because people were actually saying flywheel was one of them.
Yeah, I could see that. And to the same people that you're talking about, like all these ideas that are incredibly contrarian, yet every single one of their friends think exactly the same way.
I know. Yeah, that's a good example, yeah.
I have encountered that on a couple specific things lately. And it's like, come on, man, it's not contrarian if all your friends think the same way. I mean, you're all thinking the same way, coming at it from the same angle. Maybe be exposed to why, that might not be right or as easy as you say.
Yeah.
Specifically, I've heard that a lot with like, why couldn't the FDA approve the vaccine the day after Moderna figured it out? It's like, no, there's a pretty damn rational explanation. It's not some sort of anti-tech bias.
Yep.
But that's a tangent. Sorry, but I think that is a kind of thinking that's kind of perverse and a little too common. Another one. There's reflexive contrarianism is something that I've encountered. Is a name that I'd call it, where certain people are, made their reputation with something contrarian, so they try to take a contrarian angle to everything, even where there isn't one that exists. And I think investors kind of fall guilty to that too, because every one of us, to want to beat the market means you want to be right about something that the market's wrong by definition. So you think you're contrarian in some ways, but that's hard. That's hard. Hard to have an angle that's contrarian to everything.
100%. Yeah, that's exactly right. And I think that's why I said, I think one of the things I've really learned to appreciate over the years is your most dangerous assumption is often based on your previous conclusion, right? So I've seen tons of people, myself included, get things horribly wrong right after they just got something right. So I learned this thankfully quickly and not too painfully, but I think I've talked about this on here before. When I started in this business, I was assigned through random luck to cover financial companies in 2007. and because we were in a long short hedge fund, I ended up just saying, look, this is going bankrupt, this is going to zero, this is overvalued. So we shorted a million different things and made a ton of money in 2008. And on the basis of that, opened a short-only fund in 2009. That was not my idea. I wasn't the one who was solely responsible for it by any stretch. But, I saw that play out over and over again, where people that made tons of money off of the Big Short, so to speak, just kept trying to reinvent the Big Short. I mean, remember when Meredith Whitney came out and was going to short every municipal credit for the next, it's like everybody just tried to reinvent what had just worked. And being contrarian all the time, like you said, is by definition not going to work, right? You have to pick your spots and be contrarian when it makes sense and when the odds are actually favorable, not just because it sounds cool.
That's a strong point, because your most vulnerable weaknesses come immediately after your strengths, and there should be a name for that. I know Kahneman talked about the research he did on Israeli Air Force pilots in training, I think, where there was no correlation between praise and subsequent performance. But there should be a name for that.
There probably is. I'm blanking on what the concept might be referred to in the academic literature, but yeah.
Well, I'll volunteer a suggestion. It could be something like God complex. Because do you know how that resonates with me? Because literally, like, I made the biggest mistake of my investing career right after having my biggest win. And I mean, I cringe when I think back at my thought, what was going through my head after that biggest win. But I was like, that whole thing about thinking in probabilities. Well, God doesn't think in probabilities, right? I mean, God knows what's going to happen. So why should I be thinking in probabilities? I mean, it was literally that level of hubris. And of course, then, what happened next, which was like just blowing everything I had just made on an idea where I thought I was so smart and actually I wasn't. So that's one example. But Phil, thank you so much for mentioning Carlos Kaiser, because now I have a plan B for my son.
He's going to have to have a lot of attributes that, were very special. You got to really play the role, right? I mean, it's truly marketing and acting. I mean, he's going to have to get a stylist and a publicist, and he's going to have to get a lot of things. So.
Yeah, well, that's a skill in and of itself.
It sure is. No, it's very real. Yeah, I mean, whether it's a con artist of athletic, endeavors or business endeavors, I mean, look, the ability to sell is very much a skill in and of itself, and it can be used for good and it can be used for bad.
Yeah, but what you said about Munger being actually so far ahead of his time and ahead of kind of the prevailing wisdom in academic economics is just so spot on. I mean, I've thought a bunch of times in the past that if you're a PhD student or something like that, you could literally just take ideas from Munger, wrap them into like PhD style papers, and get professorships or ultimately the Nobel Prize, because he was just so spot on about a lot of these things. And I feel like it's so useful to be aware of this as a defensive strategy, basically. I feel like where I have a little bit of a problem with some of these things is that you take some of the leading business schools in the country and they're actually teaching these things as offensive weapons. And I would argue we're now seeing it used with things like Robinhood and others, but basically things like social engineering, neurolinguistic programming, and stuff like that. Like, it's good to be aware of these things, but it's like, supplying defensive weapons to a country, let's say giving them anti-tank missiles versus giving them tanks that could be used offensively. I just find that, those who have the power to kind of teach these things should be a little bit more aware of how those things are going to be used. And then one other comment on just this, things like flywheel, I have another example, which is Fortress balance sheet. And I think somebody, Daniel Gladish, tweeted about Jamie Dimon perhaps using that for the first time.
He's been using that a lot. I mean, he's been referring to that for several years at least.
Yeah, using that. And I guess it applies to JP Morgan, but I've heard companies talk about a fortress balance sheet in their investor presentations where they don't actually show the balance sheet. And then you go to their SEC filings and it's like, whoa, there's a bunch of debt. There's, it's not a fortress balance sheet, but it gets used so much. So that's just another little
that's a good
example
one.
of
I mean,
that.
we talked about the corporate claptrap concept and baloney detection kits and all that a couple of weeks ago, and I thought that was actually a fascinating discussion. And that probably does deserve its own line item or chapter in this presentation, because the use of vapid, meaningless language, yoga babble, psychobabble, all this kind of nonsensical garbage really does utilize a lot of the other psychological concepts to often a nefarious end. So I think it's worth studying. I mean, frankly, I would put non-GAAP financial metrics in there, right? And I think the argument in favor of non-GAAP financial metrics is that they can be used by companies with good intentions to explain the business as they see it, as agents and principals, hopefully, of the business that they're trying to steward to the best possible long-term results. But we all know that non-GAAP financial metrics often venture into the absolutely absurd and the downright, malignant use of misleading numbers. And so I would put that in the same category of the vapid, meaningless language that can be so misleading. And it ties into other psychological principles. It's not necessarily a standalone principle, but definitely something to take note of.
Yeah, it's interesting. All of them start with a rational basis and an effective path to helping simplify and tell the real story. And all of them kind of evolve in purpose to something that's far removed from where they initially started.
Yeah, that's exactly right. I mean, it's the slippery slope concept, right? I mean, it's just, I don't care whether it's garbage financial reporting or outright fraud. I mean, the vast majority of misdeeds and bad behavior do not start out as intentional, right? It's like all of a sudden you wake up and go, oh my gosh, how did I get here? And it's, well, you did one little thing, and then you have the inconsistency tendency creep up, and you don't want to reverse yourself, so you just keep going a little bit further and a little bit further and a little bit further, and you end up in a really bad place.
Yeah, and of course it has often to do with incentives, right? Where
Sure,
you just have an incentive to not really think rigorously about what is the best metric to use, but you want to use the most favorable looking metric. So, it's like a good idea pushed too far can become a bad idea, because GAAP isn't necessarily the best, but it is standardized. But if you're just using GAAP, you would have missed out on a lot of great value creators like an Amazon, like a Netflix, like some John Malone companies probably. So there's definitely value to non-GAAP measures, but it's just when you couple just the complete ability to define those in any way that a management team wants, you couple that with their incentives, you get a lot of really, really meaningless and vapid and misleading financial measures.
Yeah, exactly. I didn't mean to imply, it's a good clarification. I'm glad you brought that up, because I didn't mean to imply that there's one single truth in accounting. I mean, accounting, even in a more extreme fashion than in investing, does not have any absolute answers. This isn't physics, and accounting, more than just about any other practice or profession, requires an enormous amount of judgment. But to your point, whether it's IFRS or GAAP, there are accounting standards boards that are by no means perfect, but they get a lot of the big things right. And by standardizing it, they allow a clearer, more uniform picture to play out. And so, yes, it's going to create all sorts of weird distortions and weird results. But my opinion would be that by doing it that way, rather than just allowing effectively a free-for-all where the rules aren't enforced and anyone can use non-GAAP metrics to mislead at their, because again, they're not even necessarily trying to mislead because they're bad people. It's incentive caused bias. I mean, if you had to rank these issues of psychology on the psychology of human misjudgment, incentive caused bias would be right up there at the top, right? I mean, it is right there at the very heart of what makes people human. And so this is, non-GAAP financial metrics are just a tool to enable incentive caused bias to metastasize into all sorts of crazy stuff.
You put that so well, man. Perfect.
Well, on that note, guys, thank you so much for another great discussion. Really enjoyed this, and I hope all of our listeners did as well. Till next week, take care.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.